A short while ago, I met a Liverpool-based landlord with 64 buy-to-let properties. His properties were over-leveraged, under-rented, and he was struggling to exit his portfolio. And this got me thinking, what does the future look like for most investors' property portfolios? You see, most property investors watch the good side of property on YouTube. They see the successful property flips, they see the Lambos, they see the people that have built property portfolios that allow them to leave their jobs, including me. You might have watched me back when I was working for someone else, doing all hours under the sun, and now you've seen me move over to become a business owner, work for myself, and live as a full-time property investor. But a trend that I have noticed is that when you ask a lot of property investors, what will you do with your portfolio in 20 years' time? Well, not many people have an answer. And this is a problem. I believe we should always begin with the end in mind. And before I go on to explain my ideas in more detail, if you haven't done your first property deal, then do not focus too deeply on this video. You simply need to just get started. Do the first deal, make the first mistake, or hopefully make the first bit of money, gain the experience, and then move on to thinking deeper about the future of your portfolio. For those of you that are a few properties in, you need to ask yourself this: what will you do with your property portfolio at 50 years old? And more importantly, what does your life look like at 50 years old? I can tell you what mine looks like. I'm located in the south of France for a large part of my year. Every morning I get up and I walk along the seafront, perhaps in Cannes, to collect my morning newspaper, if newspapers are still a thing then. I buy some fresh food, I replenish my cigar collection, then I walk home debating my plans for the afternoon, so that once I've got back, I've made my investment decisions for the morning, had a nice lunch. What's my plan for the afternoon? And obviously, that's just this kind of dream, this idea that I build up in my head in order to chase that goal and make that a reality. But that's really important for you to think about. Why are you doing this in the first place? And as for my property portfolio, well, it's going to have reduced in size. It's going to be debt-free, and it will only have the best buy-to-let units remaining and earning me good money each month. Now, after hearing that, there are going to be a few different types of people. There's 3 of them, I believe, to be exact. We, first of all, like me, have the lean machine, okay? Someone that wants to build a portfolio up, but then reduce that debt down and have a lean portfolio going into their retirement. We then have what I call the leveraged lunatic. Yes, I'm obviously making these up and it's a bit of a joke, but the leveraged lunatic builds a massive portfolio and is saying things like, I'm gonna die with all my debt, silly remarks like that. They're just building, leveraged and over-leveraged, to be quite frank, and not thinking about what that future looks like. And then last but not least, you have the quitter. Definitely don't be this guy, don't be the quitter. Really, the quitter is someone that gets started, thinks they're gonna build a portfolio, finds it all too stressful because a couple of mistakes happen, and then they just exit out way earlier than retirement and they leave, okay? Don't be the quitter. No one likes them. Nothing in life comes easy. So if you can't handle when property goes wrong or gets stressful, then probably just don't even get started in the first place. But today I am gonna focus on the lean machine, okay? That is what I'm gonna be doing with my portfolio over the upcoming 20 years. And I don't agree with people that want to remain leveraged up to their eyeballs into retirement. In fact, the only time I think it's appropriate to do that is when you are building a multi-generational business to then pass down onto the generations below. And even then, I think it's better to probably at least reduce some of that debt so you don't pass it on to someone else. So to start with, here are my beliefs around building an efficient property portfolio. To start with, I think we should be focusing on cash flow. I mean, we should always focus on cash flow in the sense that properties should always cash flow. You shouldn't buy something just for the sake of holding it and hoping it's going to go up in capital value and capital appreciation, because you need a property to cash flow to offset things that can come up. So I think many of us start with this in mind, and I think this is the right place to go, okay? That might mean going to a slightly lower value area in order to make your capital work harder and return higher. So we focus on cash flow first. And I think that's where you should maybe spend the first 5 years of your growth, focusing on that to build up income and bring that in. But then I think we should, at some point, when we've got the income, not continue to just buy properties purely off the basis of yield or return on investment. And then we should start to think more about wealth. Okay, and what do I mean by wealth? Okay, well, we should start to think about that, yes, the income is what's going to allow us to build this bigger, maybe leave our job, etc. But it's wealth that actually where the true money is made in property. And we can build up our wealth by increasing our net wealth or our net value, okay? So by buying higher value properties, by buying things that might expose you to more capital growth, using the cash flow that we built up will then allow us to build a higher value portfolio. So we then basically use the cash flow, then start buying potentially higher value properties or properties in better areas to then build up our wealth. Once we've done that, okay, these are different stages, I believe, of building that efficient portfolio, thinking about the future, not thinking about the short term. Once we've built wealth, well, it's no good having all those higher value properties if everything is absolutely leveraged to the nines. We then need to start thinking about the debt that we have and doing some tax planning. Again, if you're not thinking about these things in the future, then they are going to come to bite you at some point, unless, again, you're planning to pass this down the line. But for many of us, I believe, we are planning to build something to allow us this kind of comfortable, cushy lifestyle going into retirement. So I think the next stage for us is to be thinking about debt and tax planning. So we've built the cash flow, we're building up wealth through higher value properties. Now we need to start thinking about how can we reduce down the debt and how can we then plan for the tax implications of selling some of those properties in the future, okay? Or how can we extract as much money from that portfolio for a comfortable lifestyle with as little tax as possible. And then, of course, once we've done that, once we're successfully in this phase of doing that, we can then start to think about our retirement planning. As I said, for many of us, this is what we've got in mind for the future. Okay, yes, we're building this to create something now, but we're also creating a certain lifestyle in the future. So once we've started to reduce that debt down, then we can start to think about what does retirement look like? How do I get the income that I want from this property portfolio whilst having reduced lots of debt and obviously efficiently planned for taxes? So that's what I believe are like the 4 stages of building an efficient portfolio, thinking about the retirement side of things, not thinking about the short-term side of things. So hopefully this has got you thinking. I really want for this to be kind of a thought-provoking exercise for you so that you can go away and think about how does this apply to my plans and my property investing journey. But let me paint a picture of this kind of lean machine property portfolio investor. In case this is you, right? This could be an investor that has the goal of reaching £4,000 profit per month in order to leave their job. Their main goal, or your main goal, might be to do that during your 20s, 30s or 40s. So therefore you might aim for 15 buy-to-lets so that you perhaps go past that goal, produce about £5,000 per month in profit. This investor then builds that portfolio of 15 properties, which, by the way, is absolutely possible for anyone watching this. Whether you've got £30,000 starting capital or £300,000, if you learn the right skills and you have the right hunger for it, then you can absolutely make that happen. So 15 properties have been bought, but they are likely to be at kind of the maximum leverage, 75% loan to value, highly leveraged, as you will likely have refinanced at every opportunity to continue that growth and build that portfolio. Now, I'm actually going to draw out the idea here, okay, which is of having 15 houses. Okay, so there are the 15 houses. You're going to have to, excuse my drawing, but there's 15 houses. Now, over time, statistically speaking, you'll have 5 properties that will cash flow, okay? And they're going to do better than expected. You might then have 5 properties that have gained in value, and then you're going to have 5 absolute pigs. Okay, so 5 that cash flow, 5 that go up in value well, and 5 absolute pigs that you just want to get rid of. You don't want to own anymore, okay? We're all going to have that, okay? When you grow a portfolio, you're going to have your good ones, you're going to have your bad ones. But the goal in my eyes is to take the cash flowing ones and use any of the excess money from those properties in order to overpay the debt on the good houses. So either the cash flowing ones or the value ones, okay? And you want to slowly chip away at that debt year after year with the excess profits. In its early years, you'll probably do this via still interest-only mortgages, but now you might make 10% overpayments each year. You see, overpayments actually come directly off the debt, so it's not a bad strategy to do that. And as time goes on, you'll have remortgages that come up, and they'll come up at the end of your 2 or your 5-year mortgage terms. And this will be your opportunity to start switching some of these mortgages from interest only to repayment. And particularly for those of you that don't trust yourself to make those overpayments each year, well, then the repayment mortgage strategy might be the best one, so then you're definitely paying down the debt. And you're probably going to do that from the cash flowing ones more than anything, because they've got excess cash flow. Use that excess cash flow to potentially pay down the debt on them. And then perhaps you do this in stages. Let me explain. So in years 0 to 5, you are probably in a stage of growth. Again, going back to that cash flow side of things, okay? You're probably on interest-only mortgages, so interest-only, and you're growing the portfolio in growth mode. In years 5 to 10, you are probably still continuing to grow in order to get up to the amount of properties you want. So you'll be doing the new ones on interest-only mortgages, but you might also have some old stock, which you switch over perhaps 25% of the older properties that you've got in years 0 to 5 over to RP repayment, because now you've got new ones you're buying, putting them on interest only, so you continue growth, but then you're starting to reduce the debt on 25% of the older ones that you bought in years 0 to 5. Then in years 10 to 15, perhaps your growth slows. And now you're thinking about moving, 50% of your portfolio over to repayment, okay? And you might do this by switching them onto repayment products or making overpayments each year. Now for the final stage, I've kind of put 20 years plus, but you could say years 15 to 20 or 20 years plus, okay? You're gonna sell off the worst of your stock. You're gonna sell off the pigs that I mentioned, okay? Or you might even do that before that. But you're gonna sell them off, settle your tax, and use the equity that you had in those properties to repay. So I wanna take equity, repay good stock. And what I mean by that is like you're taking the remaining debt on your good properties, and then you're taking the equity from the ones you've sold to repay off that remaining debt. And you're gonna do that in order to get an unencumbered portfolio, also meaning no mortgages, maximum profit, okay? Because you might end up with less units, but now you've got less mortgage payments going out, meaning it'll probably profit more, or at least the same as when you had more properties, basically. Now, this is what I call a time-based exit strategy. I think I've made that up, okay? But you could also have a value-based exit strategy, which is more focused around your income and building up your portfolio value. I'd say a value-based exit strategy is actually better for those of you starting a portfolio at 40 years old and above. But anyone can use that strategy, doesn't matter what age you're at. Now, my caveat to this whole presentation about creating a lean machine property portfolio is that this is a far better model for those of you looking for a portfolio to pay for a comfortable life or retirement. As mentioned, those of you that are building to pass this on to someone, to a future generation, well, you could follow the same approach, or you could keep a bit more leverage in order to grow the portfolio bigger and the income bigger. And for those of you thinking, well, I don't want to pay down the debt, I want to take the income for myself and not have to make repayments or overpayments, well, let's just say a magical thing actually happens when your portfolio produces enough income for you to leave your job, okay? You now have this 40 hours of free. And what many people do is either go on to build bigger portfolios, or they go on to have other entrepreneurial successes because they get bored. And for many of us, it's wired in our brain to always be active. So your direction might change as time goes on. And right now you think, well, I want to produce income in my portfolio and then I want to live off of that. But actually, by freeing yourself from your job, you end up creating this other business. And then all of a sudden, that business is where you're taking your money from. And actually, you can leave the profits in your portfolio and then use those profits to pay down the debt and think of this as more of a long-term vehicle. I think and hope that makes sense. But overall, lead with the end in mind. And this is exactly what successful entrepreneurs do. They build it like a business that they can exit from. And they have this plan from the minute they start. And this is absolutely no different when it comes to property. In fact, once you've sat down and reviewed your own personal portfolio goals and decided what your future looks like for you, well, then you are going to suddenly realize actually how urgency is so important. Saving up your money slowly to build a portfolio over the next 10 or 15 years is too slow. Okay, you need to move with speed, and you actually need to be a little bit impatient. Okay, macro patience, micro impatience. Wake up daily hungry. As always, I hope this video has been useful, insightful. Let me know what you think in the comments below. Thank you for watching, and well, I'm going to see you next week, won't I?